All right, let's take a look back at this day in history, because it was on this day 27 years ago when long-term capital management, one of the most lauded and opaque hedge funds ever created, was forced into a $3.5 billion bailout. A stunning fall from grace for the brainchild of former Salomon Brothers trader John Meriwether, who in 1994 recruited financial industry heavyweights like Goldman chairman John Corzine, New York Fed President William McDonough, future Nobel winners Myron Scholes and Robert Merton, and three of the brightest mathematical minds in the world, Victor Haghani, Lawrence Hillenbrand, and David Mullins. It was the Wall Street equivalent of an NBA all-star team. That brainpower was the secret sauce behind the fund's quant models that sought to exploit the presumed convergence in spreads between risk-free and risky assets. Buy the risky assets the model showed would appreciate, while simultaneously betting against the risk-free assets that were supposed to fall in value. That strategy, it was wildly successful. 21% annualized returns after fees in year one, 40% returns in year two and in year three. But it was in year four, 1998, where things went terribly wrong. The lingering effects of the 1997 Asian financial crisis had already made global investors skittish, testing long-term capital management's risk parameters. But it was Russia's debt default in August 1998 that sent investors on a mad dash for risk-free assets and a hasty retreat from everything else. In short, everything that long-term capital management owned, risky assets, was falling in price, and everything that it had sold short, sovereign risk-free debt, was going up in price. The counter moves, combined with the fund's outsized leverage, led to $4 billion in losses that brought it to the verge of collapse. It was only the mutual self-interest of the fund's lenders and a bit of nudging by the Federal Reserve that forced the heads of 14 Wall Street banks to ante up the money for a rescue, though the fund would eventually be liquidated a couple years later. The coordinated bailout has been widely derided for sending a signal that banks could take as much risk as they want, since the government would ride to their rescue to prevent widespread fallout. Too big to fail, if you will. A historical marker that likely paved the way for the U.S. bank bailouts that would come a decade later in 2008. Bailouts that fundamentally reshaped Wall Street, Main Street, and Washington alike in ways that we're still wrestling with today.